Welcome to Boots Off, Log On, a podcast where we talk all things farm business. A show about the business of farming, bringing you insights and wisdom from the leaders in farm business, helping you minimise risk and maximise return on all your hard work. I'm David, and I'll be your host for the show. Welcome everybody. Today, this morning, we're day 2 at the Dowerin Field Days and doing our podcast series from the field day. And I'm talking to Scott Green, who's from, I've just been getting it right, from Ord Minnett. So tell us about yourself, Scott.
No worries. Thanks, David. Yeah, we're a private wealth advisors, so coming from a stockbroking background, stockbroking firm from a long way back, roots back to 1872.
Wow.
I've recently been working for a company called Bailey's, and Ord's bought them a couple of years ago. There's a bit of merging going on in the area, in the industry. It's great to be here at the Dowerin Field Days 2 years in a row as Ord Minnett. Looking forward to doing it many more times. Yeah,
tell us a bit about yourself. So, have you been a career stockbroker? Or a wealth manager? I don't know what to call you. So, what do I call you, Scott?
Stockbroker, financial advisor. Let's say financial advisor.
So tell us about that. So, have you been in financial advisoring and stockbroking your whole life?
For about 11 years, I actually moved over from engineering prior to that. So, I was oil and gas engineering and project managing for the first 15 odd years of my career, and now about 11 or so in the stockbroking financial advising world. So
was it hard to get you? I mean, were you an amateur trader before you became a professional one?
I was, yeah. So and I loved it, so I wanted to try something, do it full time, I guess.
So this was a hobby that turned into a career, was it?
Pretty much, yeah. It was a big career move for me.
It would have been, yeah.
A bit of a scary one, but I'm pleased to say that 11 years on, I'm happy with the decision. So
yeah, definitely. So when you did that, is there skills that you could transfer? Like I always say, I've got a 25-year career in software, and before that I was a farmer, right? And so there's always skills. There's a lot of things that are very different, but a lot of things the same. So what skills did you bring across from, engineering or your engineering mindset that's really helped you in your career in wealth management?
I think from there's just an underlying analytical skill base that you get from engineering, as you can probably gather, and quite a systematic approach to. I think that's one thing that I do as my offering as a financial advisor, is I'm quite systematic about the way I put people's portfolios together, and routine reviews of the portfolios according to asset allocation, which is the proportion of your wealth that you're holding in shares, bonds, Australian shares, international shares, that sort of thing. And I look at it on a quarterly basis to see whether any adjustments in that area need to be done. Yeah. And that actually drives returns for portfolios. Statistically, it's something like 85-90% of the portfolio return is driven by what assets you're in rather than what individual stocks you're in. Yeah. So that's a big focus of mine.
So focusing on asset classes.
Yeah, that's right. Yeah.
And so that begs a question. So, it's both. It seems simple, but it's insanely complex. So what are the common mistakes that not only you made when you were an amateur trader as opposed to a professional trader, and you see clients and future clients and clients who wish you had? These common mistakes people make when they're managing wealth or trading, or what are the things that people just get wrong that seem obvious but aren't?
I think there's some human nature steps in when you've got something that's gone down and you want to get your money back. But unfortunately, the big bad market out there doesn't care how much Scott Green or David or anybody else paid for their Wesfarmers shares or their whatever shares on any given day. So you've got to think of it like that. You wake up in the morning, and if you think it's still a good idea to buy those shares, if you would buy them if you didn't have them already, then perhaps that's a good idea. But if not, maybe get rid of them and take a little bit of pain sometimes.
Yeah, and so there's a difference. You'd have a lot of clients here at Dowerin who some of them are very experienced in grain trading, which there'd be a lot of similarities. So there's I always think in grain trading, I always think there's a fine line between hedging and speculating, right?
Yeah, that's right.
And the same with shares. Is there a difference between trading and wealth management? And what is that nuance?
Absolutely, yeah. So I think you can certainly look at it from a technical point of view, technical meaning trading volumes and where the charts are going and uptrends, downtrends, that sort of stuff. But that's more of a short-term approach. And there's some merit to it, but it's pretty hard to get it right on a consistent basis, where for most people I think it makes more sense to think of it for the long term. Look at the asset class first, as we talked about, but then when you're choosing a company, make sure it's earning good money, stable and perhaps growing income, and really think about the downside risk. Most people think about the upside when they buy into something, but you've really got to think about the downside risk as well.
So at the end of the day, you're talking about just good business fundamentals. A good business is a good business, regardless of whether it's a $5 billion business or a $100,000 business. Good business is good business, and the fundamentals are the same, yeah?
That's right, yeah. So we do a bit of short-term trading around the edges, I suppose, but we like to have a core portfolio that's chugging along for the long term and hopefully delivering a decent return over the longer term.
Now, especially, I know the grain guys are finding it really hard at the moment because that whole derivatives market has just gone nuts, and there doesn't have that. Are we finding the same? So how are you finding it you're talking to clients all the time and you're advising clients on their wealth management, and the world's not exactly the most organised and stable place at the moment. Is the share market the same thing as what the guys are seeing in the grain derivatives market?
Very much so, yeah. Apart from anything else, we're in a rising interest rate environment at the moment, inflation, interest rates, and it pretty much always creates a lot of volatility in the market. Singular issues that are going on at the moment as well, which are plenty of them, and so the market's being thrown around a lot by the likes of the Russia-Ukraine war and inflation caused by supply chain issues coming out of China with their zero COVID policy and all these sorts of things.
So does that just change instead of reacting, right, you're talking about trading and holding, is it just then you as an organisation, as a personal advisor, just telling people, okay, these are the asset classes that are still fundamentally strong regardless of what the volatility is happening in Ukraine, or did those classes change in this sort of environment?
Well, I think one thing that we're much keener on after a 6-month sort of fall in the share markets and the bond markets is that bonds are something you can buy again now, whereas a year ago they were paying next to nothing in income.
Yeah, because that's interest rate related?
That's right, okay. And there was all the risk of when interest rates went up that the values of the bonds would go down, but that's now happened. So now, after a very long time, there's some Australian corporate bonds and other styles of bonds that are getting up around the 4, perhaps even 5% mark, which is starting to look much more attractive. Yeah. And you don't have that downside risk because we've already seen a lot of the rising in interest rates, and markets are forward-looking, so any future interest rates have been baked into the prices to some extent. So there's a lot less downside risk there with the bonds. So those sorts of things are a really good place to start when you're putting a portfolio together.
So that's the thing, when you're looking at the market, and we tend to look at interest rates, I'm talking about myself probably and others, is that we tend to see them, even though we're businesses, look at them in a very much consumer sense, how much we're going to pay on the debt we're carrying, right? Yeah. Whereas the market seems to see it in a different way. So we're talking about the market. So the market's already baking into everything in the pricing these interest rate rises that are perceived to, they think they were going to come through the rest of this year. So when we look at it, we might go, well, is it going to go up? Whereas the market's always going, we're just factoring that into the price. Is that how it's sort of working?
Yeah, there's always an element of forward-looking speculation in the market. So, and that's what makes it jump around, and it is doing that a lot at the moment. We had a little bit of a relief rally in the US in particular on things like the tech stocks, and that was sort of based on softer inflation numbers coming out of the US after everyone being very concerned about inflation. But now we've seen a little bit of a pullback again because people are realising, well, there's a reason why those inflation numbers were soft, and that's because economies are slowing. So the pendulum swings back and forth quite rapidly at the moment in terms of risk on, risk off, they talk about. Yeah. Yeah, and that's basically just the market trying to see what's happening in 6 months' time.
Yeah, trying to there's these second order effects. If that, it's not black and white. If that happens when this happens, well, this also happens. So that's what you're trying to predict.
Yeah.
So the traders, especially, I suppose.
Yeah. And so it is jumping around quite a bit at the moment. So we do have quite a bit of volatility on the market, which is probably on average a bit of a down pressure on the share market, and so therefore we're holding reasonably high levels of cash as well, just to make sure that if we do see a really big downturn, we've got some opportunity to pick up things cheap.
And that's another interesting thing. Cash, I always love the view from both an accounting point of view and a trading point of view, cash as an asset class as opposed to something you use, like it's a... it's a commodity, a global commodity, really, isn't it?
That's right, yeah. And it's, you can make some really good money if you've got cash available when you see a really sharp downturn in the market when it bounces back. In. That's it, yeah. So you need to have that. You need to keep a bit of that firepower, so to speak.
So does cash move counter-cyclical? So like, say you want cash reserves to buy in. Let's say a bunch of class of stocks dive, and so is it because markets move together in a way, whereas cash is a bit decoupled from that in a way? So you can actually say, a whole lot of shares have dropped, but this cash reserve we hasn't, so we can buy in cheap. Is that
exactly right? Yeah.
Okay.
That's it. Yeah. So it's always good to have some firepower there. On the other hand, though, we do meet a lot of people, particularly here at Dowerin, that might have all cash and shares, and they've probably got too much cash.
Yeah.
And so that's where some of these bond type investments are a good place to start for us as advisors, where we're saying, well, you should get some of that cash working harder for you, and get your 4, 5, 6% for it, rather than where are we at these days, maybe 2 or so for cash in the bank. That's where you need to have basically a little bit of everything. There's opportunities with the shares as well, even though you've got to be super careful and manage your downside risk. The volatility does create opportunities as well.
Well, that's what he's saying, that the bargain hunting with your cash pile,
Yeah, that's right.
So tell us a bit about, clients come into your tent here at Dowerin, and we've had some clients who, all around Western Australia, and the Australian reality had a pretty good season last year, and there's always a lot of risk, so a lot of them need that cash, there's a good buffer that's required. But when they walk into Ord Minnett, what should they expect, and what can a company like Ord Minnett do for a client who walks in and goes, look, I've got some spare capital, or I want to look after my life going forward, post 50 or whatever. I don't know what the age bracket is, but what do you do as a firm, and how do you approach clients? What do you offer them?
I guess the first place to start is we are direct marketing investment advisors, but the first place to start is more on the financial planning side of things. Mm-hmm. So I love the fact that I work for a stockbroking type firm, because it gives you the flexibility to invest in just about anything, more so than any other. But it's very important to be doing that all within a really robust financial planning framework. Mm-hmm. So that's the first place to start. Really get to know the client and what they need and what their situation is, what their attitudes to risk comes into it as well, what their capacities for risk are. These sorts of things are where we start.
And can you offer products like if people need liquidity? They need to put money away, but they need liquidity to get it out if they need it, right? Especially in grain and higher risk stuff where they might need the cash to, because you never know.
That's right, yeah. And I think for those sorts of reasons, it makes sense for farmers to hold a reasonable, probably higher than average sort of level of cash to be prepared for those sorts of things as well. But on the other hand, there's liquidity is a very good word for it for farming families, etc., because they quite often don't have the liquidity. Succession planning and things like that can become quite difficult because they tend to be asset rich and income poor with their farms and that sort of thing. So when we're putting a portfolio together, it's in things that can be bought and sold on the share market very readily. So basically that's if they have a portfolio with us, it means that they've got some liquidity. You can't sell, let's talk about a house. You can't sell just one bedroom of a house, but if you've got 500 Wesfarmers shares, you can sell 25, 50, 100, however many you want or you need, so it gives you that liquidity.
Is there ways for people, this is my ignorance in market, is there a way to people to participate in that property market indirectly through derivatives or things like that, or shares in property? So if I don't want to hold, like you said, assets that aren't liquid, like investment properties and whatever, but I want to participate in the commercial or the retail property market, is there ways people can do that and have liquidity?
Absolutely, yeah. We were talking about asset classes and asset allocation. Well, property is one of those asset classes, and there's certainly plenty of ways to invest on the Australian market. Doesn't have to be the Australian listed market, so trading on the ASX is what I'm talking about there, but it can actually be global property, and so you've got all kinds of choices. You can decide on something that's focused on residential property or property developing or commercial property or global property or combinations of all of those things.
So if you look at the property market and you look at long-term returns on, say, the ASX versus property but you can participate in all those classes and still have liquidity that you might want.
Yeah, that's right. We're what we would say probably underweight on the property side of things at the moment, but it's definitely there as an option.
Yeah, no, it's just that some people love the idea of property, but the immediate thing we think of is buying actually real estate, don't we? Like, we don't think about derivatives in real estate or shares in real estate.
Yeah.
Well, I don't anyway.
And the things that we need to try to introduce into the conversation are, well, if you go and do that and you buy a property, that's a big investment, and it's going to reduce your liquidity and all these sorts of things. Yeah. Definitely. So that's where the value of having an advisor comes in, I think. For people.
Definitely. So if people want to come and work out how to manage their wealth, if people want to get hold of you, they just Google you, or what's the easiest way to find you, Scott?
I think if you put in Scott Green Ord Minnett or Ord Minnett Perth, you'll certainly come up and it'll say Our People, and I have my profile there, so people can look me up there.
And Ord Minnett is a double N, by the way, double N double T, isn't it?
Yeah, there you go. And see, I just called it Ord Minnett, so either or is fine.
Yeah, so it's just when you're Googling, guys, double N double T.
Yeah, that's it. And my email address is scottgreen@wards.com.au.
There you go.
So more than happy to hear from anyone out there who might need a bit of advice.
There you go, guys. So if you need a good advisor, go see Scott and give him a call or an email or whatever, and we'll go from there. Thank you very much for your time, and I hope you have a good rest of the day.
Good on you. You too, David.
Okay,
Thanks.
you.
As always, if you'd like to know more about AgriMaster Farm Business Management Software and Services, you can find us at www.agrimaster.com.au or find us on Twitter, LinkedIn, Facebook and Instagram. If you like this episode, please share it on social media or directly with a friend, and let's make farm business great together.